Hey there, it's Sarah. This week we're going to learn all about credit with Bryce Conway. He is a travel hacker, entrepreneur, author, and creator of 10x Travel. So without any further ado, here's Bryce.
What is a credit score? Your credit score is a number that represents your creditworthiness. Think of it like the grade you are getting in credit if credit were a class at school. Virtually everyone in the United States has a credit score, and it determines whether they're able to be approved for loans and other types of credit and how much they'll pay for them. There's a handful of different scoring models used by different industries, but by far the most common one is called FICO, and it ranges from 300, which is bad, to 850, which is great. When people talk about credit scores, they're almost always referring to FICO credit scores. So how is your credit score calculated? Officially, your credit score is calculated as follows. 35% of it is based on payment history. Basically, this looks at how often you pay your credit bills on time. Note that this only counts credit payments, which are things like credit cards, student loans, car loans, etc. It does not count things like rent, utility bills, or other similar bills. 30% of your score is amounts owed. This looks at the total amount of available credit that you are using. The lower this percentage, the better your credit score, unless it's zero, which we'll talk about in a bit. Think of your total available credit limits like RPMs in your car. You don't want to be redlining it all the way at the max. That's going to hurt your score. You want to only use a small percentage of your available credit. 15% of your score is based on length of credit history. The longer you've been using credit, the better. This looks specifically at the age of your oldest account, the age of your newest account, and the average age of all of your accounts. 10% is something called credit mix. This looks at the different types of accounts you have, such as credit cards, installment loans, mortgages, etc. The more variety you have, the better your score. But of course, you should never open something like a mortgage just to improve your credit score. That's crazy. 10% is new credit. This looks at how much new credit you've applied for lately. More equals detrimental to your score. So how to get a good credit score in plain English? There are 4 rules to follow. Number 1, never miss a payment. If at all possible, make all your payments on time, even if you can only make the minimum payments. 2, get way more credit than you'll ever need, like way more than you ever need. This is incredibly counterintuitive to most people, but it's incredibly helpful to your credit score because it helps with that amounts owed part of your score. If you have tons of available credit, you'll never have to worry about that percentage going too high. Number 3, keep your oldest account open. Even if you rarely use it, even if you just put a Netflix expense on it, turn on auto pay, put it in your sock drawer, that's fine, but keep it open. It's gonna help your score. Number 4, nothing else matters. You're gonna hear all about credit mix and inquiries and what time to open new cards and things like that. None of that really matters. As long as you never miss a payment, get way more credit than you ever need, and keep your oldest account open, you're gonna be just fine. How to check your credit score. There are 2 main ways to do this. There's paid options and there are free options. Let's start with the free ones. These are things like Credit Karma, Credit Sesame, or the free scores that are provided by your bank or credit card when you log in. These are often referred to as FACO scores, kind of a wordplay on FICO, but they're called FACO because they're just third-party guesses. These are not official scores. These are third parties looking at your data and just guessing what your score is. And in my experience, they tend to be incredibly inaccurate. So while they are directionally good and can't hurt to look at them, don't treat them as gospel. The second option is paid, which are things like Experian.com's subscription service. They're usually about $15 a month. These are going to show you your actual real credit score, but you shouldn't have to pay $15 a month to access that. So there's one option here that kind of does both, and it's called Discover Scorecard. This is an entirely free service that shows you your real FICO score. Anyone can access it. You don't have to be a Discover customer, and I recommend it to anyone. Let's talk about some common credit myths. The most common one, does checking your credit hurt your score? Short answer, no. Unless, of course, you're asking your friend at a bank to process an application for you to check your credit. That would. But if you're just using any of these free services or even the paid services to check your score, there's absolutely no impact. You could check your score every hour if you wanted to. No worries. Myth number 2, is it bad for your credit to have lots of credit cards? Surprisingly, no. In fact, it's probably really good for your credit. This is counterintuitive because most people believe that lots of credit cards equals lots of credit card debt and overall bad thing, which might be true. But from at least a credit score standpoint, more credit cards is almost always a good thing. Myth number 3, does closing a credit card help your score? No. In fact, it will almost certainly hurt it. Closed cards will stay on your report for a while anyway, so you can't just close a card and delete it from your report and pretend it never happened. Myth number 4, does my job or income impact my credit score? No, not at all. You could get a $200,000 raise at work, no impact to your credit. You could be fired, no impact to your credit. It's not reflected whatsoever. Let's talk about a couple common credit mistakes. Number 1 is a fear of credit. This is by far the most common mistake that I see, and it's one that comes from a good place, but it often doesn't end up well. People will open one credit card, they'll rarely use it, they'll pay it off every other week, thinking that by just dabbling in credit, this is going to help their score. But the opposite is generally true. If you don't have enough credit or you don't use it very often, you're going to see negative impacts on your score for a whole variety of reasons. Number 2, paying credit cards early. I know a lot of people who pay their credit cards bi-weekly, weekly, sometimes even daily. They'll log in and pay it off when they make a purchase. This can actually backfire because it can prevent you from building credit history. So the better way to approach it is to just treat your credit like a cable bill or any other utility. You wouldn't log in and pay $5.99 because you just rented a movie on demand on cable. You wait for the bill and you pay it. It's best to do the same thing for credit. Third one is a pursuit of an 850 credit score, which is the top of the range. This is a little bit more rare, but you do kind of get the type A types who want to have that perfect score. And what I can tell you is that it's probably going to be impossible for most people. Not because you're not able to do the things that would have a good credit score, but because you might not be old enough to have credit history, or you don't have a mortgage or other types of debt that would lead to a much higher score. So don't worry about it. Last one is assuming that you can undo past credit mistakes quickly, maybe paying off a bad debt and hoping that it'll go away. Your credit report is a bit like your driving record. You don't get an entirely clean slate just because you pay off all your speeding tickets. That history is still going to be there. And the same is true of credit. Most things are going to stay there for about 7 years. So while it's a generally good idea to pay off old debts like that, don't assume that doing so will immediately fix your score. I'm Bryce Conway with 10x Travel, and that's what to know about credit.